can delve into further, I would like to show you an example. Allow me to share my screen. Okay, I hope my screen is visible, Archana.
Yes, it's visible. Please go ahead.
Right. I'm just starting with an example to say what cash can do to you. So we've got concepts of cash, we've got concept of credit, and we've got a concept of how we have a managed outlook, what cash profits mean, what accounting profits mean, and how they look different. So let's assume we start off a business with, say, 1,000 lakh of rupees. We have invested that capital. Out of this 1,000 lakh rupees, we use 300 lakh rupees for our fixed assets and assuming the rest is available to our business for doing the regular business. And you understand that just fixed assets do not help us in doing the business. We need raw material, we need to pay salaries. And that's the second where I'm looking at the P&L, which in the first year where we say we've purchased raw material worth 500 lakhs, salaries paid 200 lakhs. With these two in place, we've been able to build the product and services and we've sold it for 900 lakh rupees. Now, 700 lakh is the cost and sales is 900 lakh. But thanks to accounting, you purchased your fixed asset for 300 lakh rupees, but you are allowed to depreciate it over 3 years. So this 300 is not a cost, but you depreciate it over the lifetime. Let's say this machinery is valued for 3 years. You provide for 100 rupees of this as an expense in your P&L. Net 800 of cost, 900 of your inflow, and then profit is 100. Look, this is a book profit. This is not a cash profit. Now I take you on to the right side where we have the cash profits. Now we start with the cash flow. You had an opening cash of 1,000 lakh rupees. You paid for your fixed assets, you pay for your raw material, salaries, and then you get receipt. So you have made a cash sale of 900 lakh rupees. Your cash in hand net is 900. Now, what is your cash profit? Cash profit is nothing but your closing cash, which is 900 lakhs, minus your opening cash, which is 1,000. So, in effect, in the first year, you've made a loss of 100 lakh rupees, which is a cash loss. Having said that, book profit is still 100. This is one concept of cash. Now, in the next year, we will see how we do what we do to this business further. You have 900 lakhs of cash. So, this I bring it from the previous business 900 lakhs of cash that we have. We use it for our business again, purchase raw materials, salaries. We've been able to increase our business this year because we have more cash in our hand. And then we have the depreciation. Since we have more raw material, we are able to sell more. We are able to add on to the inflation, and we have a sale here. And we have made a profit of 181 lakh rupees. Now, this is again your book profit. I come to the right side now. You have a cash of 900 lakh. You paid for your expenses, raw material, salary. You've received your sales in cash, which means you have realized your cash. And then your cash at the end of the year is 1,181 lakh rupees. In effect, if you were to consider closing cash minus opening cash, your cash profit is 281 lakh rupees. Wow, this is very good when compared to my book profit of 181 lakh rupees. Now, definitely you would look at cash in your hand and say it is much more tangible. You are able to appreciate it better because you have that in your bank account now. I'll move on to the second concept of credit. Now, in the concept of credit, the first year remains unchanged, but for the fact that you have not got cash when you have sold it, assuming you have sold it for a 2 year credit period. Very hypothetical situation, but you never know when such things can happen. This is a very bad decision making, is something that you will realize at a later point in time. Assuming your sales is for a 2 year credit, which means you have sold, you've not got any cash. So, out of all the money that you have at the end of the year, since you've not received anything from sale, your cash balance is zero. Your cash profit is zero. Having said that, your P&L profit remains unchanged. You have still made 100 lakh rupees of profit as per books. But do you see cash in your hand? No. You've lost whatever you had in your hand. So for first year, almost similar, but for the cash losses that you have incurred. Now let's move to the second year. Second year, everything else remaining unchanged. assuming you've purchased the same amount of material, paid the same amount of salary, depreciation remaining same, your sales value remaining the same. The difference is you don't have a cash at the beginning of the year. You didn't have to purchase fixed assets, but you have paid up for the raw material and salary. Now, where did you get the money from? You had to borrow the money because you didn't have money in your hand. What did you end up doing? Because you borrowed money, you had to pay interest on it. So you paid an interest also on that. And third, you were not receiving any money because on your sale, because you are selling it on a credit of 2 years period, which means at the end of the year you have a borrowing of 990 lakh rupees. And that's your cash loss again of 990. First year you had 1000 lakh cash loss. Second year you have 990 lakh cash loss. Now, looking at the book profit, in the previous example, we saw book profit was 181 lakh rupees. Here, because you have an element of interest, you've lost your profit and it's become almost half or little less than half to 91 lakh rupees. Now, we'll move to the third example where we have partly something on cash, partly something on credit. First year remaining unchanged, you have a capital investment, you have a fixed asset purchased. The next point, which is on raw material, you had to purchase raw materials, but here you've said that you're not going to be paying cash immediately. You're going to be postponing it by taking a credit period. So let's assume you've been able to get a beautiful credit negotiation of 1 year by when you need to pay your raw material. So upfront, nothing to pay, but your expense continues. Similarly, salaries generally we do not negotiate. We have to pay the employees. You can't have an employee who's working on credit for you. So let's say we will pay the salary, and on the sales bit of it, where we assume that the sale remains 900 lakhs, we have given 50% on credit and 50% on cash, which means you still have some part of money that you have received from your business. So going with the cash flows, you have a closing balance of 950 lakhs. Opening closing cash minus opening cash, you've only burnt 50 lakh 50 lakh rupees of cash in the first year. Book profit, no change. In all the three examples, you see the book profits has got no change. It's only the cash profit which has gone undergone a change from very first year. Let's move to the second year now. Second year, you have had exactly the same scenario. You have purchased the same raw material, paid your salary here. Purchase of raw material here, I'm not saying you have paid, I'm only saying you have incurred an expenditure here. Salary you have paid out and depreciation over 3 years. Your expense, your sales remains unchanged at 181 lakh rupees. Now, if you were to look at your raw material purchased and salary and look at what you have as a opening cash balance, I come to the right side of the table where we have said we have an opening cash balance of 950 lakhs. You've paid up for your raw material, say 50%. Here we are paying for the first year. We have got the second year fully in credit. This is nothing but what we had to pay for the first year. And then we have paid up for the salary. And then we have received something from credit from last year, which is 50% of sale which was made on credit and 50% of current year's sale which was received in cash. So closing cash balance comes to us with 1,285 lakhs. Now, where is your profit? Cash profit is 385. Now look at your expenses. You had an opening cash balance of 950. You paid for raw material and salary. Now you still have something balance which is about 230 lakhs. What do you do with that? Either you will invest into your own business or say you want to hold some cash and you make an investment. You place an FD, let's assume, and you have got some interest on it. Now that also adds to your profit. Now that's not just cash profit, but that is also your P&L profit. So in the second year where you've had partly credit and partly cash, you're making a profit of 195, which is the best scenario here. Now, in all these three situations, we have seen the book profits for the first year remain unchanged, whereas from the second year, it undergoes a difference. If I have to give you the book profit as a percentage, first year you will see the profit is 11%. Second year, you will see profit of 15% when it is cash. In the credit scenario where purchase is on credit but sale purchase is on cash but sale is on credit, first year no change to profitability, second year your profit reduces to 8%. Third one, where we have managed capital, working capital by taking credit and giving credit. First year profits, no change. Second year profits, woo, 17%. And cash profits have also been the highest in the entire example, all the three examples that I have given. Best working capital managed gives you the best capital cash profits. Now, this is what I would like to share today in a little more detail in the entire journey that we have. In the example that we saw that just by making cash payments, you don't make profits. But at the same time, if you give everything on credit, you need to be aware that you will have losses. So the new non-finance persons should know that they need to probably negotiate for their sale as well as for the purchases. Unless and until they have negotiated the purchase period or the sale period, they should not sell it at the same price in both the scenarios. So assuming you have a credit period on your sale and a credit period on the purchases, which means you are able to effectively get the money from your debtors, pay it to your creditors. You don't have to borrow additionally, which means you are in a very good cash flow position. On the other hand, if you have taken a credit, then you should give and you have to give a credit. See that your negotiations on the purchases of credit period or the discounts that you need to consider are well managed in your pricing to ensure your profits are good. As Archana was rightly mentioning, it is a misconception that cash flow management is of the finance department or the treasury department. As I mentioned to you, every department, whether it's a sale or a procurement department or a service department, needs to negotiate and understand the impact of cash and liquidity in its business and its profitability. Each one of us is responsible. And when we understand this better, together we are able to bring an impact on the organization's profitability and liquidity. Now we've spoken of profit, we've understood what cash can do versus credit and say working capital management. Now, if I were to tell you liquidity is king, you may all laugh saying that this world lives on credit. What are the banks doing by lending you loans, or what are these large NBFCs doing giving you credit? While profitability is a theoretical concept, uh, unless you realize it in cash, it's not actual profit to you. I would say why. When you have book profits, you have something of the past and something of the future. In the example that I gave you, you had purchased the fixed assets already, but you had not expensed it because of accounting concept. You bring in your accounting concept, and in future you incur expenditure on it. What does it mean? That's not your actual loss for the year or the expense for the year, but you have to bring in forcefully as an expense in your P&L just because the accounting concepts require you to do that. Your decisions on payments and your credit terms with customers or your inventory levels will help you manage what is liquidity. Now, if I have to tell you that business will die when there is no cash, but if there is a loss, your business will not die. I don't know how many of you appreciate it. Is there anybody who disagrees with me here?
Please use the chat screen and let us know yes or no, agree or disagree. Please use the chat screen and reply agree or disagree. Ramesh says agree.
Great. So we have consents here to say that it's not just always profits, it is the cash which decides the future of the company, whether it will do the business or whether it will die. Because profits can be arrived with deferment of expenses or by advancing the expenses. Even taxation works on a similar line. You can have deferred tax expenses. You can pay for the taxes tomorrow. You don't have to pay for the taxes today. So the accounting concept of taxes, concept of profitability is very different from cash. Liquidity is a very vicious circle. If you don't have cash, you can't do your business. You don't have money to purchase your raw material. You don't have money to pay your workers. And if you are not able to pay your employees, who would work? Employees are the only people, or the labor class is the only one which works on daily cash. Business can still work on credit. So if you're not able to pay your employees, the business will stop. There will be no production at all. If you don't have production, what will you sell? There is nothing to sell, which means you are practically bringing your business to a halt. Now, when we are speaking of cash can lead to a death of business, or the non-existence or reduced cash can lead to a death of a business, I would like to give you a very infamous example which happened in early 2000s, which is Lehman Brothers. Lehman Brothers, I don't know what is the age of this gathering here, but people who had graduated or just started their work around this time would have known the issues that came out of Lehman Brothers. It was a worldwide issue. This company was the fourth large investment bank in the US. Its core business was investment banking, trading, securitization, and it invested in residential real estate business. Business is all doing good. And what the company did was it would borrow short term with long term assets. So effectively, it was doing borrowing, but it was somehow managing. And what was it doing? It was doing risky accounting practices. I'll tell you what this means. So they probably did sale and lease back, which was at back and then not a illegal accounting. It was still okay. Now, what happens because of this risky accounting practice and this reliance of short-term borrowing with long-term assets? Uh, when the prices started falling in the US for the residential property, the paying power of the customers fell, and there were huge defaults which started rising in this mortgage environment. Lenders lost confidence in this company, and they came, and it was a run on the money. They had to repay. What was the company facing? It was facing huge paper losses. Not that it didn't have assets, it had huge mortgage assets. But what was happening is people were running for money behind the company. The company could not liquidate its assets in time. It had huge assets, but not being able to sell in time to repay its debt. Now, this is what is liquidity crisis. Lehman fell into this uh, unfortunate situation of full asset which had no liquidity. Massive losses came up, and the short-term lenders refused to roll over their funding, which means they didn't have money to run their business as usual. Now, in our examples, in our daily life, if I have to give you some example, knowingly or unknowingly, we take decisions of investments in both liquid and illiquid investments. I'll give you examples. Investment in FD, or some of them are financially savvy. They may invest in money market instruments. They know some debt mutual funds are there, or some people may invest into money market directly. But some of them also invest into housing. These are long term decisions. But little do we understand, or little do we realize, that these FDs can be liquidated easily. I go to the bank, tell them that I want to have a prematurity of fixed deposits. It's possible. I can sell the money market instrument at any point in time. Debt mutual funds don't stop me from withdrawing the money. I can always take it back quickly. It's a matter of 1 day, 2 day, or maximum 3-4 days, depending upon holidays or whatever is the business day. But when it comes to sale of property, it's not easy. Even though your property is in the prime location, it is sweetly priced. It's in Indian context, if I have to say, it's a very nice 2 bedroom, 3 bedroom apartment which can be sold off like a hot cake. Even then, the gestation period of selling your property and getting the money is a minimum. The earliest I would say is 1 month's time, because of the complications that are involved, the regulations that are involved, that can that can delay the process. So now you see the subtle difference. You need the money today. What can give you the money? The FD that you break, you will get money today. But a house that you want to sell, which has a higher value than the FD, will give you 1 month later. So, which is better off? Today's cash is better than tomorrow that you need to pay, because some debtor is behind me to pay the money. I have to pay to ensure my business is going on. So, this is the importance of cash that we have in our business. It's extremely important to have cash, and that to cash which is circulating. Now, why do I say circulating? Because if you have cash, you may say that I have stock with me. Stock again takes a while for you to circulate. Will the stock help you repay the pay the salaries to the employees? No. You can't tell the employees take the stock instead of salary. So that's the importance to say that you need to have cash or liquidity in your organization. Now, how is this managed? You, as I mentioned, manage it in different ways. The procurement department will ensure that it is able to negotiate its buying terms, delay or postpone the payments, or get some discounts if they have to pay in advance. The sales department will ensure that they are able to get most of their sales in cash, or if there is a deferment, then that pricing is included for that credit period. Then the stores manager will ensure that he doesn't have huge stocks piled up with him. He would rather want to liquidate the stocks and keep only to the extent he requires for running the daily business, which means there is adequate cash for paying your business needs, buying your procurement, and taking care of your stock without an impact to your sales. Your sales is not impacted because the stock is there to the extent just required to manage your business. Now, now, I would like to also bring your attention to a fact that banks also have a very high importance or emphasis on working capital management. When a bank is giving you loan, they have something called working capital loan, which is specially to manage your working capital gaps. Now, this is a special loan that they give you. This is not like a long-term loan. This is a short-term loan. And what do the banks do when they have to monitor this? They ensure that your short term needs are met with this short term funds, and you don't use the short term funds to buy fixed assets, because they know that the funds in rotation, which is in short term, can be managed much easily than the funds that you have procured for a short term but put to use for a long term. Now, why is this difficult? As I mentioned to you about your house property, now you have taken a working capital loan. You're supposed to repay it in a 1 year's time, typically. That's a maximum tenor given. But if you have invested this in a fixed asset is supposed to be used in your business for over 3 to 5 years. I'm assuming that's the running life, or maybe large machineries, 10 years, 15 years, or 100 years. But you don't sell your fixed assets on a daily basis, which means you don't have money to do your regular business, nor do you want to sell your business to repay your debt. So you get into a cash crunch situation, and that is where optimizing your working capital needs becomes very important from a bank's perspective. And every department, as I mentioned, should contribute to this strategic decision of working capital. Now, apart from strategic working capital, you need to understand you have a limited cash only. In our example that we saw, you have been able to invest only thousand lakhs of cash. You don't have anything more or anything less when you start the business, which means you need to think through what is it that you need to do with that. How much of money to be allocated for fixed assets, how much of money to be allocated for your working capital needs. So this decision of allocation is also very strategic to consider your business is running. You could have said that I would use this thousand out of the 7,000, 70% I would invest in fixed assets and get and use the balance 30% in your daily working business. But that's not going to fetch you as much of profitability, because fixed assets run over a long time, as the nature of the asset is. So you need to strike a balance between using of this capital into your long term and short term needs. Now, coming to what is it that cash can do to you? Cash can help you do the business. At the same time, it can be risky. Now, why do I say cash can be risky? Uh, now, if you don't have cash, you are not able to do your business, is what I mentioned. So, you have to proactively manage your cash flow requirement or your funding requirement. And these are decisions which will impact you positively as well as negatively in your business. I'll give you examples here. Now, you have a business which is going up for, say, valuation. Now, typically, valuers look at what is the cash flow generation ability of your business. They are not looking at just your book profits. They are looking at how much of cash will be made and within what tenor. What is the sustainability of this profit making ability of the company? So this is on one side. The other side, when we look at debt, where the rating agencies are constantly looking at how much of cash you can generate. They're not just looking at your future, but they're also looking at your past. What is your repayment history? How good, bad have you done with the funds that you have borrowed? Are you in time in repaying, not in time with repaying? Which means they are telling the potential investors how much of risk is involved if you invest in this company, either by way of debt or liquidity. And hence cash becomes again important. Cash is also important for your sustainable business. Now, the cash non-finance leader here should understand that their decisions are for long-term business and not for a short-term business, and hence they need to collaborate with the finance team, understand the needs of finance, and then look at modeling their business. Uh, now somebody may say that I have a good business going on. Why should I keep cash with me? I have a cash flow coming in. I have been making payments promptly. But why should I keep cash with me? That's a very good question that people may ask. The question here is, are you prepared for unforeseen events? Now, here is where I would like to bring your attention to one of the recent issues that the entire world face. During COVID, the businesses were, the entire country was under lockdown. In fact, the whole world was under lockdown. There was no manufacturing, there was no sale. But still, if you had noticed, companies were holding large amount of cash. Was it a planning error? Were they doing something inadvertently erroneous? What do you think would have been the reason for them to hoard the money? I think the answer would have been just to be cautious, which is what I said. You need to think through what cash can do for you, not just today, but for tomorrow. When the business opens up, they wanted to use this money in their business and ensure that they can meet the obligations, they can do the business as is without any delay. And also, if I have to just, jokingly pass a reference, many of us study this concepts of what is stock turnover ratio, current asset ratio, liquidity ratios. These are not bookish concepts. When we are studying, we probably do not appreciate them. But trust me, when you use these in your management decision making, they make a whole lot of difference. And that is why the management lessons that are taught to you are about cash management.
That's wonderful. So rightfully said, Miss Kritika. Yesterday you texted me and asked that how long is it okay if we extend the session? How hard and fast are we with regards to time management? Trust me, I didn't understand it then, but I'm understanding it now. And just to give you a small insight, so we have the participant count here. 90 percentage of them are actually from people who are in the treasury, cash management, people from bank. They are the ones who have joined in insurance, etc., like that. So I'm pretty sure that they're looking for an insightful session and not just for good morning and thank you. Please feel free to extend it if required. I do not give that liberty to many of my speakers, but I would love to have that from you as well. You, I
Thank
have
you.
no issues at all.
Thank you, Archana, and apologies for this
No
extended time.
issues at all. I can understand that people are actually joined. They called me, they texted me saying that joint session is starting at 10 o'clock, right? I have not received the meeting link. How do I get it from here? How do I get it from there? You can see I'm so much distracted because side by side I'm handling the messages and the calls which are coming in as well. People have joined in for actually an insightful session, learning from you. So really, Thank you so much for taking out from your time from your schedule and coming for the session. Is what I would like to state. And also to just to state on the lighter note, I'm actually from commerce background. I'm an account student. So, just to give you an insight, look into this, I looked at it and I was like, oh my God, this is so much different from my account school. What I studied in the school. People are doing so many things in the accounts. People are so many doing things in the finance team, in the treasury team. And this is actually giving an insights into it. Thank you so much. Your first session itself, I mean, your first the balance sheet itself which you showed, the file itself which you showed gave me a very big deep insight into it is going so deep and so strong. It is not just limited to the debit and the credit side as we had learned in an account. Thank you so much for that. Okay, now we have also received one question from a participant. So if you could see in the chat screen, I put forward the question as it is. If a company is going for a loss for rupees 50 lakh, maximum tolerable, but a situation has come that if 5 more lakh has been pumped, the regaining scope is bright. Not too sure. Well, I'm not able to understand the question, but I wanted to check if you are able to understand. If not, I'll go ahead and unmute the participant.
So
Shall I?
let me read this: borrowing and line to draw. If a company is going loss for rupees 50 lakhs,
Okay, I've unmuted
maximum.
the participant. Can you please go ahead with the question again, Mr. Ramesh?
Miss Kritika, this is Ramesh here. The company is as running in the loss, that is maximum tolerable loss of 50 lakhs. This is a small enterprises. If it goes beyond that, the company will ruin. So at this stage, they got one uh, chance of investing another 5 lakhs and regaining the profit. That is scope, but that is not sure how to take decision at this moment.
Uh, Sir, as I mentioned to you, losses are not always cash losses. It is book loss. And book losses can be managed when you have a strategy to work around it. So maybe the company needs to look at what is the reason for the losses. If I have to speak around the topic, then they probably need to look at working capital management, which will give them better credit terms from their purchasers, and shorter credit tenors extended to their sales can probably bring in liquidity. And when you have liquidity, it is easier for you to ensure that the business is ongoing unless there is any fundamental issue with the business, which most of us do not see in our business. I think a book loss is still manageable. And if I have to give you a perspective, generally it is assumed that the first 3 to 5 years of the organization will be in book losses situation because of the investments that they have made, whereas the company needs to see whether they are continuing to make cash profits or not. If that answers your question, Mr. Ramesh, I'll be happy. If not, you can probably reiterate your question.
Thanks, Ms. Kritika, but unfortunately, I am not a graduate, commerce graduate. To some extent, based on my experience, I can understand your context. I cannot put a word for that, but I can understand conceptually. I can understand why this question means any individual who is investing in share market or something, they are unable to stop their when they are making loss. They are unable to stop, keep on investing and making the loss and going to suicide. That same scenario I'm applying for the company. That's what the question.
Okay, let me reiterate here. There is a stop loss concept in the stock market which people should be aware of. Unfortunately, amateur investors just jump into it because somebody has told them about stock market, but that's not the case with the business. When somebody is passionate about doing the business, he only probably doesn't understand the accounting part of it. But the person who is doing his sole proprietary business definitely understands what is cash. And there is a lot of difference between investing in stock market and business, sir. So let us keep the two aside. If the proprietor is burning his cash, then it is appropriate for him to take a call on stopping the business, which is what is the concept of stop loss in your stock market.
Thank you, madam. Thank you. Thank you.
Thank you so much, Kritika. So now coming across again over to you. Many that is the risk, which is often associated with just audits or compliance in organizations. So now, from your experience, what invisible risks? Okay, just like how we saw one sheet, which probably many of us are not so much insightful as to how deep it goes. So, in the same manner, what invisible risks do finance leaders unknowingly create through everyday decisions and communication?
You're rightful in saying that it's not just the non-finance professionals who undertake finance risk, but it's also the finance professionals who take unknowing finance risk. So, if I have to start with a small aspect, which many of us as a proprietor may brush it aside, say forecasting of cash. The importance of forecasting cash is absolutely important in the business, to the extent that it needs to be looked not just in a robust and holistic way, but also looked at in a dynamic way, which means the business could be changing, and the forecast should also be changing accordingly. So if we were to draw parallels to say product, whether consumer durable is what is trending in the market, or say purchase of real estate is what is trending in the market, we make quick adjustments. We decide whether we want to buy consumer durable or purchase a real estate, which means we take a call on our cash flows. When I say that, it means whether I pay out from my pocket or I take a loan. This concept has to be applied in the business as well. If you do not apply this concept in the business, it can mean that you either have excessive cash which is sitting idle in your organization, which means if there is idle cash and had you known about it, you could have probably invested and made some money out of it. Or if there is shortfall of cash that you realize at the last minute, then you'll end up going and borrowing in the market at a very high price. Even if you are a financially savvy person, you know what to negotiate, what is the right rate of interest. But when you go for the last minute borrowing just to ensure that you are not a person in default or your cash flows are managed adequately, you end up paying a huge price to it. So this is one cash flow mismanagement, which or forecasting mismanagement, which professionals can undertake. Then there are other things like your banking relationship, the structure you have discussed and negotiated with the bank charges and service charges that you pay to the bank. Many of us feel that once negotiated well, that's about it. Just put it in the carpet and then the business will go on well. No, that's not the case. Many times these become a creeping cost to your organization, increasing inefficiencies, increasing your cost, and leading to missed opportunities of cash negotiations, cash pooling, or your FX losses. Now, again, since I spoke of FX loss, I would like to tell you many of us these days are looking at import export business, or some businesses do have a foreign exchange impact on that. And we know that India is an emerging market where rupee is constantly depreciating. But having said that, there are times when rupee has appreciated. Now, in a situation where rupee is appreciating and rupee is depreciating, and we have importers here in place who says that I have a large import or I have a large loan. Rupee is anyway depreciating. Let's not hedge it. Then he's going to be headed for a huge loss in future. Now, when does that? If I have to tell you how this can happen. I'll give you another recent example. We saw the USD INR movement pre-COVID, the exchange rates. So between 2018-19, exchange rate of USD INR was 69.70. Then during COVID, say between 2019 to 22, this inched up from 70 to 75. Then immediately after COVID, this inched up from 70, 75 to 80, 83 in 2023. Now, okay, 2023, we were still in 80, 83 rupees. From then, within a matter of 2 years, this has inched up to 91 rupees suddenly. Now, nobody knows when this price will go up or down. Just because the exchange rates have been settled for a very long time, or they have been moving in your favor, it is not appropriate for you to leave the hedge open. It is better that you take an appropriate hedge. So, foreign exchange is a big punt which financial professionals would undertake, and I would highly discourage that, because this is something that we are shooting in the blind spot. then finance professionals also sometimes believe that working capital management is just their department. Just like how others feel that it is finance department, finance also feels that they own it up with pride and say it is all mine. No, you need to know when to procure, when to pay for the procurement, and at what point in time you need to spend that cash or realize that cash, which means you need to collaboratively work with across the departments and ensure that your cash flows are well managed. So finance cannot work in isolation, but they have to work cohesively with all other departments for better working capital management. Small other factors: there are some large organizations who lack visibility of cash position. As a small team, we probably know how much is the cash, but when it comes to larger teams, when they want to look at group liquidity and see where there can be efficiencies created by cash pooling, if they don't have a visibility, it's a very small thing but can create big impact. Unnecessarily, there will be liquidity in one side and you will end up borrowing on the other side. And last but not the least, which you yourself mentioned, in this heavy regulatory changing environment, if you shoot in the blind spot, then it's going to be very difficult. Overlooking regulations can lead you into not just failure of compliance, but lead you into hefty payment of fines, reputation management, and God knows, if you're a borrowing company, your rating can be impacted or your financial operators can come on you. So these are unfortunate, or some of the financial
Mhm.
risks that even finance professionals overlook at.
It's wonderful, actually. A perfect example, also, which you have given with regards to taking up the responsibility, taking up the ownership. But here's one thing, Ms. Kritika. Sometimes the budgets are tight and the priorities they compete. In such a situation, how can leaders communicate financial decisions without losing trust or credibility with their teams? Give me
This is
just
a
a second.
good
I'll turn
question.
off the video, please.
So this is a very good question, and often some of the new leaders stumble upon these situation and they do not know how to manage. Just like we say, faith born out of fear is fragile, and faith born out of understanding is endurance. Fear enforces rules. Understanding reveals their purpose. So blindly following rules can collapse one day, but understanding the purpose and then performing leads to a deeper appreciation and persuasion of companies' goals. So here is where the leaders have to do an effective communication and tell them the importance of how they need to probably use the cash, whether it's a strategic decision. And if I have to first of all differentiate, leaders will have to very clearly spell out to the people that there are two kinds of investments that they make. One is capital investment, which is for efficiency creation or your growth, and second one is your revenue expenses, which is more from a maintenance perspective. And if you ask me which one is important, both are equally important. But what is more important is to strike a balance. As I mentioned, if you were to invest heavily into technology, but you don't have money to pay your people, what would you do of the technology? Similarly, if you have too much of people, then it becomes inefficient. So, somewhere your profitability or your cash profits will start speaking about it. So, the better way is to clarify the people on striking the right balance. Pull out the reports. So here the finance professionals can probably pull out reports, help the non-financial professionals understand and interpret what it means for them. For example, there are jargons like EBITDA. They will say EBITDA is low, EBITDA is high, so you need to work around it. What does it mean? What does it mean to the non-finance background person? Now, EBITDA, for the people who are newcomers, it's a earning before interest, tax, depreciation, and amortization. If you see, there are a lot of concepts other than cash which is here. How much of money the business makes from its core operations just before accounting gimmicks can kicking and financing decisions can come into picture. This differentiates between book profit, EBITDA, and cash profits is absolutely important for the finance professionals to explain to the community in large. While the EBITDA may focus on operating cash generation ability, not necessarily it will guarantee cash returns. So you should be able to explain them that EBITDA may show maybe core business strength, but it may ignore accounting distortions, which means you get a better ability to see what the business is doing. Use it to compare different companies because, as I mentioned, if there is a lack of cash, then the business can die. So, with the cash that is there, you can compare two different organizations and bring out the positives and negatives and indicate the potential to generate more cash. Now, what EBITDA cannot tell you is also equally important to be told. It's not just important to tell you what it can tell you, but what it cannot show you. It cannot tell you whether a customer has repaid in time, whether it's repaid fully, whether there is cash left in left finally at the end of business. These are few factors it ignores. So you have to explain every concept to them very clearly and then tell them why do we need to look at cash management, or why do we need to conserve cash. um, there are ways to tell them, but it's important to tell them that it is that forecasting the cash flows together as a team is important. Tell them that your input is
Really, please
important for
respond.
forecasting to the finance team, and show them the result once this dynamic forecasting has been done to say what are the results achieved. And had this information not been received, had we stuck to the old plan, then what would have been the profits to the organization. Also, we should encourage the people in speaking about finance much more vocally than creating a psychological fear in their mind. So, in case a department has overshot its budget, it's better that both the teams speak out and say that there is an overrun on the budget, instead of keeping it under the carpet and letting it go as is. Take a stock on of that position and see whether it's important to continue that investment over the long run, short run. What are the implications that it may have? And then take a decisive call. In case it requires a pause to the investment, that's when it should be. This is one of the calls which finance professionals should encourage the departments in talking and arriving, so that nobody suffers. Because today you pause the investment, there should be a communication with various people, between the finance team, between the procurement team, as well as the service provider or the person who's investing into it, so that they are not in a state of unaware situation. They know that this is currently paused but will go ahead in future, and this will help in ensuring that we are able to manage both, not just our cash, but also the person who is working with us, he's also aware. And also, it is important to be absolutely transparent with the cash that you have in your hand. Lead by example wherever it is possible. So, if it's very important, it's very easy to say cut your travel. That's the first thing that people do when they have to work around the budgets. But who does the first? I think the leaders of the organization lead by examples by saying that we have a system in place where we can do meetings effectively. Let's cut the travel and do the communication on the online mode. So, leading by example is also one of the important tasks for the organization under such circumstances.
Hmm. Based on all the discussions and all the deep insights which I've got from you, Ms. Kritika, I would say that now I would be saying the leaders. Sorry, give me just a second, please. The leaders whom I know, whom we know, we talk about, we can split them probably into two categories. We just have leaders who merely they manage the budgets, and also there are leaders who are financially mature and trusted, who know so many things, just like how you said. So now, in your view, what mindset shift it separates leaders, these two kind of leaders?
Okay, as a first time manager, you're given a task to cut the budget. You simply say chop 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 cut. Here, this is
True.
you look at
It is beyond it.
you look at whatever is a non-productive item, and then cut it off. So first thing that comes, cut off travel, cut off training. These are all some things that do not give you benefit in the short term, but invest into stock, invest in rather pay for the people's salary and be done with it. But in all this communication, I think Treasury should or the finance leaders should look at giving a holistic picture rather than giving half-baked story. So a manager who's a first-time person would have said cut. Whereas a leader would go behind and tell them what it means. He may say that on a sustainable basis, if we are able to reduce our travel, then it means a better, it means it's better. As a first time manager, maybe I'm excited about travel, but over the long run, my travel excitement comes down drastically. So if we were to tell that travel is a strain on the people over the long run, and hence we have seen wherever possible, avoidable, and to create a sustainable environment, reduce the travel, but don't stop effective communication by doing face to face meetings, even if it means virtual. That's an effective way of communication, I would say. Similarly, we often hear of headcount cuts in our organization. I think most organizations have this issue with AI coming up. Everybody is saying cut. Now, what people
Before
fail
AI,
to
COVID brought
understand.
it in.
So, what people fail to understand here is twofold. The intention is not to cut the existing headcount, but to elevate your level of knowledge from where you are and increase your depth of understanding. Let the AI do the basics, help you with the AI to enhance your skills and grow. That's point number one. And 99.99% of the cases, it's not about a retrenchment at all. What they look at is futuristic addition. When you have a growing organization, you have people adding on to your organization, and when they say cut, it is the futuristic headcount. Unless this communication is very clear, I think people have a fear in their mind as to what are we doing. So this is the difference between what a leader communicates vis-a-vis a manager communicating headcount cut, vis-a-vis a leader going to explain that your communication skills will be enhanced, and we are looking at not replacing the people who have left the organization or probably reduce the additional new cuts. Similarly, when it comes to explaining about budget cuts, you just need to be honest and empathetic about it. Maybe this sounds like an oxymoron, but reality is truth is truth. You can't sugarcoat it. You have to be adequately open about it. If I have to give you an example, you just tell your organization with a straight face saying, our current cash flow projection indicates we need to conserve capital to maintain our debt covenant. Can anybody question you? No, because you need to sustain your organization, which means everybody is aware that I shouldn't spend a penny more than what I have in my budget. If I can save something, great. Similarly, if we need to optimize our working capital and fund R&D because we are running a crisis where this technology might get outdated, make that communication amply clear and explain them why from a liquidity standpoint it is important to cut the budget rather than let them overdraw on the budget. Point here is to optimize. You're not asking them to cut, you're only asking them to see if there is an alternate best way of doing certain thing rather than cutting their own budgets. Focus on protecting your core assets and future cash flows in a sustainable way. That's the communication that a leader gives. And Explain them that you have not cut it arbitrarily. It's a very strategic way of thinking that has gone through it. Involve the team in the decision making. A manager may just cut top down, which is what happens in a new manager's case, but the leader involves everybody, and
Wonderful.
then he takes a collective decision, and he communicates adequately about it. Not just the cut, but he also keeps giving important updates at regular
Correct.
interval. And last but not the least, the leaders will communicate back to you after it is over to say that thank you so much for your support. We have been successful, and show them the results. So these are some of leadership skills which people can show when it comes to difficult budgeting.
Wow, wonderful. It's so much deep, like I have what heard or seen. This is the first time that I'm getting to know regarding this from your point of view. I mean, from a leader's point of view here as well. Thank you so much for this beautiful session, Ms. Kritika. I really appreciate it and I thoroughly enjoyed it. Your insights teach us not just about budgeting, finance, cash management, etc., but it also teaches us to look at it from a leader's point of view. It is very much appreciated, and thank you very much for taking out time from your schedule for the session. We are glad to have you here amongst us. Now, an important announcement for all the participants. We are excited to share that we are launching another version of the Confidence Communique Talk Show, which is exclusively for the HR professionals starting from Jan 2026. In fact, our first launch episode is tomorrow. The details of that is in the chat screen. It is called Confidence Communique HR Series for the young leaders. This series will focus on HR and workplace communication challenges with the same depth, practicality, and confidence building approach which you experience here in our talk show. So the details are shared in the chat screen. Feel free to share it across to your contacts. And before we close the session, a small note to all the participants. So I've actually cut down small session which I do. That is, I do a live coaching scenario, a quiz scenario as well. But I guess we are extending by the time limit, so let us probably take it out. Okay, because I really enjoyed the insightful session which came from you. We looked at it from a different point of view, and I'm sure that the participants who have joined here are actually all in ears for the session and the coaching session which I do or the quiz session which I do, which is to ensure that people have actually listened to it and they are actually applying it. But I'm coming to a session right now wherein people have actually joined it from their learnings in order to learn as well. So I would be taking that off from the session right now. And now a quick request to all the participants. May I please request you all to turn on a video so that we can take a quick snapshot along with our speaker here. I usually tell that in the throughout the session, but today I was not able to. So I'm not too sure how many will be. Okay, so we have got one. Thank you so much, Mr. Sheru Khan. So he joined us kind of late also, but I can see that he is coming in here for. Okay, so we have only three people here right now who are turning on the video. That's okay. I'll wait for a few more seconds. Thank you so much, Mr. Ramesh. Thank you so much. Okay, Jennifer, if you're there in the call, can we please expect a vote of thanks from you? Jennifer? Yes, not immediately, but right now I'll first take a quick pick with all of us. Okay. So on the count of three, I hope you can speak, right? Okay. On the count of three, I'll take a short pick with all of you. Okay, Deepika is also turned on the video. All right. People are turning on the video slow and slow. Thank you so much, Deepika, for turning on the video. Deepika, do I know you? Sorry, I've just unmuted you.
Yes, yes, yes. We got
Ah,
your
yes.
yeah.
Okay, that's so wonderful. Nice to connect back with you. Ah, yes. Kritika, Deepika, you would be knowing each other for sure. So you have one person here as well, apart from the others. Thank you so much. Okay, so I'll take a quick pic with all of you together on the count of three. One, two, and three. I'll take in a pic and I'll post it across in the chat screen. Please feel free to download it and use it. So now over to you, Jennifer. We would like to hear a word of thanks from you.
Thank you, Ms. Archana, for the handover. My name is Jennifer. I am a software tester. It was a beautiful and insightful session, Ms. Kritika, and I thoroughly enjoyed it. Your insight teaches us just about budgeting, finance, cash management, etc., but it also teaches us to look it from the leader's point of view. It is very much appreciated. Thank you very much for your taking a time from your schedule for the session. We are glad to have you here among us. Now, the important announcement for all participants. We are excited to share that we are launching another version of the Confidence Community Talk Show exclusively for HR professional starting January 2026. Confidence Community HR series for the young leaders. This series will focus on HR and workplace communication challenges with the same depth, practicality, and confidence building approach you experience here. Archana will share the poster and registration link in the chat. Our social media are also shared. Please like, follow, subscribe, or join. Thank you.
Thank you so much, Jennifer, for your insights here. Now, coming over. So, a heartfelt thanks to Ms. Kritika Girdhari for sharing such grounded, practical, and leadership relevant insights today. Sorry for the voice. Your ability to connect cash, risk, and accountability with everyday leadership decisions, they truly added value to this conversation. Thank you to everyone who participated so actively. Please follow us on LinkedIn, Instagram, and Facebook. Join our WhatsApp community to stay connected. As informed, we have the session every Saturday, 10 a.m. to 11 a.m. Have a confident, responsible, and influential week ahead. We'll see you next Saturday with another speaker, and we'll share the insights across to you in our community. Feel free, please, to join it for it. Any insight, any words from you, Ms. Kritika, before we end the session?
I would like to thank you and all the participants here. Thank you for giving this opportunity. I hope I was interesting and I could make sense to the people who attended.
It was wonderful, sure, sure. I speak on behalf of all the other participants. Thank you so much to the participants. Thank you so much, Kritika, as well, for taking out time from your schedule and coming for the session.
Thank you. See you.
Okay. Bye-bye, everyone.
Bye.
Take care. Meet you all on coming Saturday.